G'day, Travis Latter from Infinity Business Brokers, talking all things financial and mistakes that vendors make with Brendan Hay, Director of Oracle Business Accounting. How are you going today, Brendan?
I'm excellent, thanks, Travis. And yourself?
Look, I'm going to cut, mate. I'm really well. I'm really excited because vendors make mistakes, and what I want to do is I want to prevent them making mistakes so that we can help them get the highest price in the least amount of time with the best terms. And I think that understanding from a financial side where that's at is hopefully is beneficial to future potential vendors. So I want to cut straight to it. As an accountant, what are some of the biggest red flags that a buyer will look for in an RTO?
And I assume you're mainly focusing on the balance sheet at the moment. Some of the biggest ones are, number one, the absence of liabilities. Not a lot of small businesses accrue for annual leave, long service leave, and employment-related expenses like that. And once you get into the process, they then start rolling them in, and that's always, to me, a bit of a red flag. Inter-entity loans which don't reconcile. To me, that's an immediate red flag because it just demonstrates a lack of control and a lack of process within the business, because it's not a difficult thing to do. Director loan accounts, they're what's the business being used for by the directors if there's huge director loan accounts? Now, look, I understand privately owned companies kind of morph a little bit, but when you're trying to sell it, you've got to demonstrate its standalone capability. And if you've got huge director loan accounts, then to me, it's just not good. It's not a good look. And how do you get them out when you're selling the company or the business? Once you've actually got into the transaction, becomes messy as well. So I'd be recommending clients take the hit with dividends or do something to get them out. However you've got to do it. I suppose the only other one that I'd get concerned with is poorly reconciled debtors and creditors. And I know with RTOs, the way the billings are done and the way contracts are paid, etc., there's that time lag. I understand that, but at the same time, you've got to be able to demonstrate that you're at least reconciling and that sort of thing.
And what about on the P&L? So that's on the balance sheet side. But what are some red flags that you see on a P&L that can be avoided?
Inconsistency in regards to the way we around account usage. I'll give you an example, a common one: contracting consultants. They're intermingled, and at times they're just all over the shop. Staff allowances. Commissions paid to staff, and wages, reconciling the entire wage figure to a wage that the ATO might be advised through an instalment activity statement or a business activity statement, become issues. So be prepared to reconcile those things to make sure that they're already done, so you can just tick the box when a buyer comes in. They're the sorts of things I think, if you're reporting to an external entity like the ATO or the government because of VETIS and whatever, then make sure you can reconcile it back to what you've done. It shouldn't be hard. I mean, that should be a monthly process, internally controlled.
And what are some? So you're now acting as the accountant for a purchase of an RTO. What documents would you insist on getting?
Look, the basic ones, obviously tax returns, financial statements for the prior years. I'd like to see it on a monthly basis if we can. And obviously they need to agree. They need to reconcile. I would like to understand how business activity statements then reconcile back in, like I've touched on with salary and wages and income. Even, like RTOs don't necessarily have a GST impact with income. But as you know, with the lateness that things roll through at the end of quarters or end of months, they may not be picking it up properly. Either adjust it or pick it up in the next month, next quarter, but be able to reconcile that away so you can explain that to a potential buyer. And then you get to the expense side where there could be owner interference in the P&L, if you like, and explain that away and be prepared to explain it away rather than just bring an ad back or a round figure of an ad back in at the bottom. Be able to explain it line by line if you need to.
And do you think can a lack of clear financial records make an RTO seem less profitable than it really is?
Oh, absolutely. Yeah. And you and I have got experience in regards to that, where what should have been a very profitable sale got limited back a bit or a fair bit based on the fact that they weren't able to supply information, and at the end of the day, it took us weeks or a week or so to then go and create the document to equal it. You know what I mean? And that should not be happening. And if they'd had the right people involved at the beginning earlier, then that wouldn't have happened. I mean, we would have been able to cover that off a lot easier.
So I suppose just listening to what you've been saying, I could probably put it down to three things. And look, tell me if I'm wrong and add, subtract, do whatever you want. The first one is preparation. Be prepared ahead of the time. Most vendors aren't financially prepared to have all the documents available. The second one is make sure those documents are transparent. And the third one is having a consistent approach to the accounting methodology. How did I go in summing up?
Well, I think you're spot on. I've banged on a bit with you in meetings about there should be an exit strategy in every business, and the exit strategy shouldn't just be in 3 years or 5 years' time. The exit strategy should be what happens if one of us is sick, or what happens if we lose a key employee, or what happens. I mean? There should be strategies in place to overcome these events, and I don't think a lot of businesses have them or even think about them. And as a result, they get caught out at the very last minute, and then fire sale. In essence, they end up fire selling the thing. So that to me is critical. Transparency. The figures just have to agree. I mean, that's the underlying issue. If you want to make an adjustment, be prepared to do it. So be prepared so you can be transparent and have the conversation early on, rather than come back later and go, oh, by the way, we're going to try and claw this back, or we're going to do this. That just annoys the hell out of buyers, and they'll adjust the multiplier. Eventually, they'll just start adjusting multipliers.
Yeah. Brendan Hay from Oracle Business Accountants, thank you so much for your time. It's informative as always, and I look forward to grabbing a beer with you soon.
Look forward to it, Travis. Thanks, mate. See you soon.
Cheers.